There are numbers on every single stock page, and most investors scroll right past them because nobody ever sat down and explained what they actually mean. Today, we fix that. This video covers over 100 stock market ratios in plain language, what each one measures, why it was invented, and what it tells you before you spend a single dollar. I've organized them into 8 categories: valuation, profitability, debt and leverage, liquidity, cash flow, efficiency, growth and market, and dividend and income. And at the very end, I'll give you the one rule that makes every single ratio on this list actually useful in the real world. Most investors never learn this rule. By the time you finish this video, you will. Let's get into it. The first question any investor should ask is this stock cheap or expensive? Not in dollar terms. A $5 stock isn't automatically cheap, and a $500 stock isn't automatically expensive. Cheap or expensive relative to what the company actually earns. That's what valuation ratios answer. The most famous is the price-to-earnings ratio, PE. For every dollar the company earns in profit, how much are you paying? A PE of 20 means you're paying $20 for every $1 of earnings. Think of it like a food stall analogy. 2 stalls, same burger, one charges $10, one charges $20. The $20 one might still be the better deal if it has a line around the block every day and is opening 50 more locations. That's exactly how PE works. High PE isn't automatically bad. It means the market expects big things. Low PE isn't automatically good. It may signal trouble ahead. PE has a smarter sibling, the forward PE. Instead of using last year's earnings, it uses what analysts expect the company to earn next year. If a company had a rough year but is expected to bounce back, forward PE will look much lower than regular PE, and that gap tells you something real. The market may be pricing in a recovery before it arrives. Always compare both together. Then there's a less known but powerful version, the Shiller PE, also called CAPE, which stands for a cyclically adjusted price to earnings. Instead of 1 year of earnings, it averages the last 10 years adjusted for inflation. Why? Because 1 year of earnings can be distorted by a boom or a bust. The Shiller PE smooths all that out and gives you a long-term picture of whether the entire market or a specific stock is historically cheap or historically expensive. It's widely used to assess whether broad markets are in bubble territory. The problem with PE is that it completely ignores growth. You could be comparing a company growing at 5% a year with one growing at 30% a year, and PE treats them identically. That's where the PEG ratio comes in, price to earnings to growth. Take the PE divided by the earnings growth rate. Now you're comparing apples to apples. A PEG below 1 generally means you're getting growth at a discount. Above 1 suggests you might be overpaying for that growth. Some companies don't have earnings at all. They're burning cash to build market share. For those, use the price-to-sales ratio, PS. It compares the stock price to revenue rather than profit. A PS of 5 means you're paying $5 for every $1 of revenue. It's a rougher measure, but for early-stage growth companies, it's often the only honest number available. The price-to-book ratio, PB, compares the stock price to the company's net asset value, everything it owns minus everything it owes, liquidated today. A PB below 1 means you're buying the company for less than its parts are worth on paper, which sounds like a bargain, but often signals the market thinks those assets are overstated or the business is declining. For banks and financial companies, PB is especially critical because the entire business is built on assets. A sharper version of PB is the price-to-tangible book value, PTBV. It strips out intangible assets like brand names and goodwill, things you can't physically touch or sell, and only counts hard assets, buildings, equipment, cash. If a company's intangibles are enormous and mostly made up of past acquisitions, PTBV gives you a more conservative floor on what the company is genuinely worth in a worst-case scenario.
Here's one that doesn't get nearly enough attention, the price-to-free cash flow ratio, P over FCF. This compares the stock price to the actual cash the company generates after paying for everything it needs to keep running. Not accounting profit, actual cash. Earnings can be shaped by accounting decisions. Cash flow is much harder to fake. If a company reports strong earnings but weak free cash flow, that's a warning sign worth investigating. Now the ratio professionals use most, one most beginners have never heard of, EV over EBIT. Enterprise value divided by earnings before interest, taxes, depreciation, and amortization. EV is the total cost to acquire the entire company, market cap plus debt minus cash. EBIT is the raw operating profit before financial and accounting adjustments. Together, EV over EBIT answers how many years of core operating profit does it take to pay back what you spent buying the company. It strips out debt structure and tax differences, which makes it ideal for comparing companies across different countries. When EBIT is distorted by heavy depreciation, analysts use EV over EBIT instead, same enterprise value but divided by earnings before interest and taxes only. It captures depreciation as a real cost, which matters for capital-intensive businesses like manufacturers and utilities, where equipment wears out and must be replaced. For companies with negative EBIT, typically early-stage or unprofitable growth companies use EV over sales, same enterprise value divided by total revenue. It's the widest lens, useful when comparing a mix of profitable and pre-profit companies within the same industry. Alone, it doesn't tell you much, but relative to peers, it can highlight whether a company is significantly over or undervalued at the revenue level.
You know what you're paying. Now let's find out what you're actually getting. Profitability ratios answer one question: is this company genuinely good at making money, not just at generating revenue, at keeping some of it? Start with gross margin. Take revenue, subtract only the direct cost of producing the product, materials, manufacturing, direct labor. What's left is gross profit. Expressed as a percentage of revenue, that's gross margin. A 60% gross margin means the company keeps 60 cents of every dollar before rent, salaries, and marketing. Software companies routinely exceed 70% because shipping one more copy costs almost nothing. Grocery stores operate at 2 to 3% because the product itself is expensive to buy and store. Always compare gross margin to industry peers, never to companies in different sectors. Operating margin goes further. It subtracts all the operating costs, salaries, rent, marketing, R&D, and tells you how efficiently the entire business runs, not just the product. A company with a great product but a shrinking operating margin over multiple years is a company where costs are quietly growing faster than revenue. That gap eventually catches up. Net profit margin is the final score, profit after everything, taxes, interest on debt, all of it. What percentage of every dollar of revenue actually becomes profit for shareholders? A 20% net margin means the company keeps $20 of every $100 earned. Compare gross, operating, and net margins together, and you can see exactly where money is leaking. High gross but low operating margin points to overhead inefficiency. High operating but low net margin points to excessive debt interest. One more, EBITDA margin. EBITDA as a percentage of revenue. This is a pure measure of operational efficiency stripped of financing and accounting decisions, which makes it excellent for comparing companies across different capital structures and tax jurisdictions. It's widely used in M&A analysis and by institutional investors for exactly this reason. Now, let's talk about the ratios that measure how well management uses what it has. Return on equity, ROE. For every dollar of shareholder equity, how much profit does the company generate? If ROE is 15%, it earns 15 cents for every dollar of equity. Warren Buffett specifically looks for companies with consistently high ROE. But here's the trap. ROE can be inflated by debt. A company that borrows heavily reduces equity on its books, which makes ROE look artificially high. Always read ROE alongside debt ratios before drawing conclusions. Return on assets, ROA, is cleaner because it measures profit against total assets, everything the company owns, whether funded by equity or debt. It tells you how effectively does this company convert its asset base into earnings. A bank with billions in assets and low ROA is not deploying those assets well. A software company with few hard assets and high ROA is essentially a money-generating machine per dollar deployed. Return on capital employed, ROCE, is a favorite among value investors. It measures profit against all the capital being used, both equity and debt, which makes it a comprehensive measure of operational efficiency. A company with 20% ROCE consistently is genuinely excellent at turning invested capital into profit. Return on invested capital, ROIC, is the most precise of these. It measures profit generated on the actual capital that's been invested into the business operations, not just what's sitting on the balance sheet. The golden question with ROIC is whether it exceeds the company's cost of capital. If ROIC is 15% and the cost of capital is 8%, the company is genuinely creating value. If ROIC is below the cost of capital, the business is actually destroying value, even while reporting profits. Finally, the basic return on investment, ROI, the simplest version. For a given investment, how much did you get back relative to what you put in? It's broad, widely used, and best applied at the project or acquisition level inside a company rather than as a standalone stock ratio. Debt is a tool. Used well, it amplifies returns. Used badly, it destroys companies. Debt and leverage ratios tell you how much of a company's capital structure is borrowed and whether that borrowing is sustainable. The most common is debt to equity, DE. Total debt divided by total shareholder equity. A DE of 1 means for every dollar shareholders put in, the company has borrowed an equal dollar. A DE of 3 means $3 borrowed for every 1 of equity. Capital-intensive industries like utilities and airlines typically carry high DE because infrastructure requires enormous upfront borrowing. Tech companies tend to carry low DE. Always compare DE within the same industry. Debt to assets is simpler. Total debt divided by total assets. It tells you what percentage of everything the company owns is funded by debt. A ratio of 0.6 means 60% of assets are debt financed. The higher this number, the more vulnerable the company is to a revenue disruption because debt payments don't pause when business slows down. Debt to capital is total debt divided by total capital, debt plus equity. It's a cleaner measure of how much of the company's total funding comes from borrowed money versus owners. A debt to capital of 40% is conservative. Above 70% starts to signal significant leverage risk, depending on the industry. Then there's financial leverage ratio. Average total assets divided by average equity. It shows how many dollars of assets are deployed for every dollar of equity. High financial leverage means the company is using significant borrowing to fund its asset base. It magnifies gains in good times and magnifies losses when things go wrong. Knowing how much debt a company has is step 1. Knowing whether it can afford that debt is step 2. That's what coverage ratios do. The interest coverage ratio, also called times interest earned, divides operating profit by interest expense. If a company earns $500 million in operating profit and pays $100 million in interest, its interest coverage is 5. That means it earns 5 times what it needs to cover its interest bill. A ratio above 3 is generally comfortable. Below 1.5 is where lenders start getting nervous. Below 1 means the company isn't generating enough operating profit to pay its own interest, a serious warning sign. Net debt to EBITDA is one of the most widely used credit metrics by analysts and rating agencies. Net debt is total debt minus cash because cash can be used to pay down debt immediately. Dividing by EBITDA gives you a timeline. How many years of operating profit would it take to pay off all net debt? A ratio of 2 is generally safe. Above 4 is considered heavily leveraged. Some industries, real estate, utilities, routinely operate with higher ratios because of predictable long-term cash flows. Related is the raw debt to EBITDA. Same concept, but using gross debt rather than net. Some analysts prefer this because cash held abroad or restricted cash can't always be used to pay down debt, making the net figure potentially misleading. Always look at both and understand how the company holds its cash before deciding which version to trust more.
Debt ratios tell you about long-term financial structure. Liquidity ratios tell you something more urgent. Can this company pay its bills over the next 12 months? A profitable company can still go bankrupt if it runs out of cash at the wrong moment. Liquidity ratios measure that short-term survival capacity. The current ratio divides current assets, cash, inventory, receivables, anything convertible to cash within a year, by current liabilities, bills and obligations due within a year. A current ratio of 2 means the company has twice as much short-term assets as short-term obligations. Below 1 means it currently has more bills coming due than assets to cover them.
That's not automatically fatal. Some highly efficient companies run below 1 intentionally, but it demands explanation. The quick ratio, also called the acid test ratio, is stricter. It removes inventory from current assets before dividing. Why? Because inventory isn't always liquid. You can't always sell it quickly or at face value. The quick ratio only counts cash, short-term investments, and receivables. It's the conservative version of current ratio. A quick ratio of 1 or above is generally healthy. The strictest version is the cash ratio, just cash and cash equivalents divided by current liabilities, no receivables, no inventory, pure cash versus immediate obligations. This is what lenders look at in a stress scenario. It's almost always below 1 for healthy businesses, which is fine. Companies aren't supposed to hoard all their capital in cash. But watching this ratio trend downward over several quarters can be an early warning signal worth paying attention to. A fourth version, the operating cash flow ratio. Operating cash flow from the cash flow statement divided by current liabilities. It asks, can the company's ongoing business operations alone cover its short-term bills? This is more real than current or quick ratio because it uses actual cash generated, not accounting figures sitting on the balance sheet.
Earnings can be shaped by accounting, cash flow cannot. That's the single most important reason why cash flow ratios deserve their own section. Cash is what actually pays employees, services debt, and funds dividends. Earnings are a number. Cash is a fact. Free cash flow, FCF, is operating cash flow minus capital expenditures. It's the cash left over after the company has spent what it needs to maintain and grow its business. A company that consistently generates positive FCF has genuine financial strength. A company that shows profits but negative FCF for years is financing its lifestyle on borrowed time. When you see FCF, you see what management actually has to work with. Free cash flow yield divides FCF by the company's market capitalization. It's the inverse of P over FCF, expressed as a percentage. An FCF yield of 6% means for every $100 you invest in the stock, the company generates $6 in free cash. Compare this to bond yields or alternative investments. It helps you decide whether the stock's cash generation justifies the price you're paying. Free cash flow margin is FCF as a percentage of revenue. It tells you out of every dollar of sales how much actually becomes free cash. A company with 20% FCF margin is genuinely capital efficient. Compare this across years to see whether the business is becoming more or less efficient at converting revenue into real cash. Finally, cash flow to debt. Operating cash flow divided by total debt. It answers, if this company used all its operating cash flow to pay down debt, how long would it take? A ratio of 0.25 means it would take 4 years. This ratio is particularly useful for evaluating whether a highly leveraged company has the internal cash generation to responsibly manage its debt load without needing external financing. Efficiency ratios are about speed. How fast does this company turn its resources into revenue? A company can have great margins but terrible efficiency, meaning it ties up enormous amounts of capital just to generate each dollar of sales. That's a structural weakness that compounds over time. Asset turnover divides total revenue by average total assets. If a company generates $2 of revenue for every $1 of assets, its asset turnover is 2. Higher is better. It means the company is squeezing more revenue out of its asset base. Retailers typically have high asset turnover because they move products quickly. Heavy manufacturers and utilities have low asset turnover because their equipment and infrastructure are enormously expensive relative to revenue. Inventory turnover measures how many times a company sells and replaces its inventory in a year. High inventory turnover means products are flying off the shelves. Fast-moving consumer goods companies turn inventory dozens of times a year. Low inventory turnover means products are sitting in warehouses, tying up capital, and potentially becoming obsolete. A declining inventory turnover ratio is often an early warning signal of slowing demand before it shows up in earnings. Days Sales Outstanding, DSO, tells you the average number of days a company takes to collect payment after a sale. A DSO of 30 means customers typically pay within a month. A rising DSO can mean the company is struggling to collect or that it's offering extended credit to attract customers, which eventually creates bad debt risk. When DSO grows faster than revenue, that's a red flag. Days Inventory Outstanding, DIO, is the inventory turnover expressed as days, how long, on average, inventory sits before being sold. And Days Payable Outstanding, DPO, is the flip side, how long the company takes to pay its own suppliers. Companies with high DPO are effectively using their suppliers as free short-term financing. A DPO of 60 means the company keeps cash for 2 months before paying bills. Understanding DSO, DIO, and DPO together gives you the full cash conversion cycle, how long it takes from spending money on inventory to collecting cash from customers.
Let's pull DSO, DIO, and DPO together into one number, the cash conversion cycle, CCC. It's calculated as DIO plus DSO minus DPO. It tells you in days how long it takes to turn $1 spent on inventory into $1 collected from a customer. A shorter CCC means the company is more efficient with its working capital. Remarkably, some companies like Amazon and Walmart at their peak have run negative cash conversion cycles. That means they collect cash from customers before they pay their suppliers. Essentially, the customers are financing the business. Receivables turnover is the annual revenue divided by average accounts receivable. High receivables turnover means customers pay quickly and reliably. Low receivables turnover means money is sitting uncollected. For a business heavily reliant on credit sales, like a wholesale distributor, this ratio is critical. Watching it deteriorate is often the first sign of trouble in the customer base. And fixed asset turnover specifically measures revenue divided by net fixed assets, property, plant, and equipment. It answers how much revenue does the company generate from every dollar of physical infrastructure. A manufacturing company with $10 billion in factories that generates $8 billion in revenue has a fixed asset turnover below 1. The factories aren't being fully utilized. A company with $1 billion in equipment generating $5 billion in revenue is running a highly efficient physical operation. And one more efficiency concept, the working capital ratio, which is actually the same calculation as the current ratio, but viewed through an operational lens. Working capital is current assets minus current liabilities. Positive working capital means the company has a buffer to run daily operations. Negative working capital isn't always bad. Some businesses, like supermarkets, deliberately run negative working capital because they collect cash from sales before paying suppliers. But understanding why it's negative matters. Growth ratios answer a different question than the ratios we've covered so far. Not what is this company worth today, but is it getting better or worse? A stagnant company with great margins can still be a poor investment if the business is shrinking. These ratios track the trajectory. Earnings per share, EPS, is the total net income divided by the number of shares outstanding. It translates company-wide profit into per-share terms, which allows investors to compare across time and across companies with different share counts. Rising EPS over multiple years is one of the most reliable indicators of a fundamentally strengthening business. But always check whether EPS growth is coming from actual profit growth or from share buybacks. A company can boost EPS simply by reducing its share count, even if profits are flat. EPS growth rate measures the percentage change in EPS year over year. This is one of the core inputs into the PEG ratio. A company growing EPS at 20% per year is compounding value quickly. A company with declining EPS, even if current EPS is positive, is moving in the wrong direction. Revenue growth rate measures the year-over-year percentage change in total sales. Revenue growth often leads earnings growth. You generally can't grow profits indefinitely without growing the top line. For early-stage companies, revenue growth may be the primary metric because profitability hasn't arrived yet. Consistent double-digit revenue growth over multiple years is a powerful signal of genuine market demand.
Two more worth knowing. Free cash flow growth, the year-over-year change in FCF, tells you whether the company is becoming more or less of a cash generator over time. And book value per share growth tracks whether the underlying net worth of the company is accumulating. Both of these growing together with earnings growth is the trifecta of a genuinely compounding business.
Let's cover some market-level metrics to give you the big picture on what a company is actually worth in total, not just per share. Market capitalization is the total stock price multiplied by total shares outstanding. It's the market's current verdict on the total value of the company. Small-cap companies are typically under $2 billion, mid-cap between $2 and $10 billion, large-cap above $10 billion. Market cap alone tells you size, not value, but it sets the context for everything else. Enterprise value goes further. It adds all debt to market cap, then subtracts cash. This is the true theoretical cost of acquiring the entire company, because if you bought it, you'd inherit the debt and could keep the cash. EV is more relevant than market cap when comparing companies with very different debt levels. The earnings yield is simply the inverse of the P/E ratio, EPS divided by price expressed as a percentage. It answers, if this stock were a bond, what yield would it offer? An earnings yield of 5% means you're earning 5 cents of profit for every dollar invested. Comparing this yield to risk-free bond rates helps you judge whether equities are attractively priced relative to alternatives. One more, the Graham number, a formula created by legendary investor Benjamin Graham. It calculates the maximum price a defensive investor should pay for a stock by combining EPS and book value per share. Multiply 22.5 by EPS by book value per share, then take the square root. If the current stock price is below the Graham number, the stock may be in value territory. It's a blunt tool, but for beginners learning to think about margin of safety, it's one of the most useful starting frameworks ever devised.
If you're an income investor, someone who wants the stock to pay you regularly, not just appreciate in price, dividend ratios are your primary toolkit. These ratios tell you how much a company pays out, whether that payment is safe, and whether it's growing. Dividend yield is the annual dividend per share divided by the stock price, expressed as a percentage. A 4% dividend yield on a $50 stock means you receive $2 per share per year just for holding it. High dividend yields can be attractive, but a very high yield, say 10% or above, often signals that the stock price has fallen sharply, which means the market doubts the dividend can be maintained. Always investigate why the yield is high before assuming it's a bargain. Dividend payout ratio is the most important dividend health check. It's the percentage of earnings paid out as dividends. A payout ratio of 40% means the company pays out 40 cents for every dollar earned and keeps 60 cents to reinvest. A payout ratio of 95% is dangerous. One bad earnings quarter and the company may need to cut the dividend. Mature, stable companies can sustain higher payout ratios. Growth companies tend to have low payout ratios because they reinvest most earnings back into expansion. Dividend coverage ratio is the inverse, earnings per share divided by dividends per share. It tells you how many times over the dividend is covered by earnings. A coverage ratio of 3 means earnings are 3 times the dividend, very safe. Below 1.5, the dividend is at risk if earnings dip even slightly. Dividend per share, DPS, is simply the total dividends paid divided by shares outstanding. It's the raw cash payment per share. And finally, the dividend growth rate, the percentage by which the company has grown its dividend year over year. Companies with long, consistent dividend growth histories, sometimes called dividend aristocrats, are considered among the most reliable income investments because it takes decades of financial discipline to sustain that record. Every ratio we've covered so far measures what a company does. Risk and volatility ratios measure what the stock does, how it behaves in the market, and whether the returns you're getting are worth the risk you're taking to get them. Beta measures how much a stock moves relative to the overall market. A beta of 1 means it moves in line with the market. A beta of 1.5 means it moves 50% more. When the market drops 10%, this stock tends to drop 15%. A beta below 1 means the stock is less volatile. Defensive sectors like utilities and consumer staples tend to have low beta. Technology and growth stocks tend to run high. Beta is not about quality, it's about volatility. Understanding the beta of your holdings tells you how much turbulence your portfolio is signed up for. Standard deviation of returns is a statistical measure of how much a stock's returns swing around their average. A stock that consistently returns about 10% per year has low standard deviation. A stock that returns anywhere from -40% to +60% in different years has very high standard deviation. In investing, standard deviation is the mathematical definition of risk. More swing means more uncertainty. The Sharpe ratio combines return and risk into one elegant number. Take the investment's return, subtract the risk-free rate, typically the return on government bonds, and divide by the standard deviation. A Sharpe ratio above 1 is generally considered good. Above 2 is excellent. It answers, how much return am I getting per unit of risk taken? Two funds both returning 12% per year look identical until you see that one has a Sharpe of 2.1 and the other has a Sharpe of 0.6. The first is doing it far more efficiently. The Sortino ratio is a refinement of Sharpe. Instead of dividing by total standard deviation, it only divides by the downside standard deviation, the volatility of negative returns. The logic, upside volatility, isn't bad. Nobody complains when a stock unexpectedly surges. Sortino penalizes only the downside swings, giving a more accurate picture of risk-adjusted performance for investors focused on protecting capital. And finally, alpha, the return an investment delivers above or below what its beta would predict. An alpha of 3 means the stock returned 3% more than its level of market risk would have suggested. Positive alpha means the manager or the stock itself added genuine value beyond what market exposure alone would explain. Consistently generating positive alpha is what separates great fund managers from lucky ones.
Here is your action step for this week. Pick one stock you already own or are watching. Open any free screener, FinViz, Macro Trends, Simply Wall Street. Find its PE, debt to equity, free cash flow yield, and one efficiency ratio, either inventory turnover or asset turnover. 4 numbers. That's a complete basic health check. Not news headlines, not social media hot takes. Actual financial data that tells you what the company is genuinely doing. That is a real investor move. Now, the rule I promised you at the start, the one that makes every single ratio we covered today actually work in the real world. No ratio means anything alone. A PE of 25 is expensive for a bank. It's cheap for a fast-growing software company. An interest coverage ratio of 3 is uncomfortable for a utility with predictable regulated revenue. It's perfectly fine for a high-growth tech firm. ROE of 40% looks extraordinary until you discover it's inflated by extreme leverage. Every number in this video is the question. The comparison is the answer. Always compare against 2 things. The same company over time, is it improving or deteriorating? And its direct competitors in the same industry, is it better or worse than its peers? When you do this consistently, these ratios stop being numbers on a screen. They become a language, the language that the best investors in the world use every single day to decide where their money goes. And now you speak it too. If this video filled in gaps you didn't know you had, that's exactly what this channel is built for. Hit subscribe so you don't miss what comes next, and leave me one comment. Which single ratio surprised you the most today? I read every single one.